Advanced financial modeling. Topic 10, capital budgeting, learning objective number 5. We're going to evaluate a corporate investment with CapEx, revenues, and OpEx. OpEx, remember, is operational expenditures. CapEx is capital expenditures. So here's the example. Say Walmart wants to automate a warehouse with robotics. They're going to spend $30 million today. We'll call that T equals 0 to automate 20% of a 1 million square foot warehouse. They're going to depreciate that CapEx over 10 years using accelerated depreciation. However, the useful life is determined to be 15 years. In other words, the accountants are going to tell them to depreciate over 10 years, but when you do your estimate of the benefits of the robotics, you're going to use a 15-year window. You're going to, at the end of the 15 years, we'll assume that that CapEx has a residual value of $250,000. We'll say that robotics operating costs are 10% of the CapEx. In other words, if you spend $30 million for the CapEx, you need to spend 10% or $3 million a year to get the OpEx to work. As far as employees to use the OpEx, equipment, and things like that. So 10% of the CapEx is used annually to maintain and operate the robotics. Why are you getting the robotics? You're going to have labor savings. There are going to be 120 associates or employees via attrition, or will not hire, at $22 an hour plus 40% benefits. We'll call that fringe. So 120 employees savings at $22 an hour plus 40% of benefits times 2,000 hours a year. And that's going to save the company $7.39 million per year. The savings are not going to kick in till year 2, and they'll last till year 15. A corporate 10% overhead is also going to be applied to labor, but we're going to ignore that. So when HR tells us they're going to apply a 10% overhead to account for, say, the fixed cost of administering, say, HR benefits, we're going to ignore that. There's going to be sales lift. In other words, this new inventory system is going to get the right products on the shelf at the right time. That's going to lift sales by $7.5 million per year, starting year 2 to year 15. However, that sales, that $7.5 million, that's not profit or cash flow. That's just the revenue value. We're going to assume that 80% of that $7.5 million are COGS, cost of goods sold. So you're only effectively be able to keep 20% of that as far as profits. You're also going to use space savings. Once you use robotics, you're no longer confined to the height of a human to place items. You can have the robotics go all the way up to the ceiling. So you're going to save 40,000 square feet, valued at $120 per square feet. That's going to be a $4.8 million savings per year. And that's going to be from year 1 through year 14. But again, we'll assume that the project's going to end in year 15. So those savings go away by then. And we'll call that an opportunity cost. This is space savings. So this is space that could be used by other parts of the organization or maybe leased out to other companies. So this is an opportunity cost. You're not actually getting revenues for the space savings, but somewhere in the corporation, they could use that space, which is valued at $120 per square foot. You're going to reduce overall inventory by just having the right products at the right time using robotics. So we're going to do that inventory reduction as a reduction in working capital. We're going to assume a tax rate of 33%, and we will allow negative taxes. So if there if the project is losing money any particular year, we'll allow the taxes to be negative because we'll assume that Walmart overall is positive, so they can use those losses to offset taxes elsewhere. Also, there's an option to expand to the rest of the warehouse if this project is successful. All right, so a couple things about depreciation. First thing, if you had an accounting class, you always want to depreciate the CapEx minus the salvage value of the item. We are not going to do that. We are always going to depreciate the full CapEx amount, the cost. Okay, that's because in accounting there are two sets of books. There's the reported books and there are the tax books. The tax financial statements or tax books determine the actual tax liability and cash flows. So that's what we're using effectively when we do our modeling in finance. So in those books, The IRS says depreciate the full CapEx, not the CapEx minus anticipated salvage. So that's what we're going to do. Also, remember from the last example with the condo, the after-tax salvage, or anytime you sell a piece of CapEx in the future, you're going to get whatever that value is minus the tax rate times the difference between the salvage value or that resale value and the net book value. The net book value, by the way, is the initial book value minus the accumulated depreciation up to the time of sale. And lastly, this example is going to use a 10 years accelerated depreciation. In other words, I'm not just going to divide the CapEx divided by 10. The IRS allows you, to depreciate things faster, and that's going to increase the value of those tax savings in a present value sense. So we're going to use a 10-year accelerated depreciation. So it's not going to be 10% a year for 10 years. It's going to be 10% the first year, 18%, 14%, and you can see that last year is 3%. By the way, FYI, fun fact, anytime you use that accelerated recovery period or accelerated depreciation and you say it's a 10-year depreciation, it's actually 11 years because it's assumed 2.5 years for the first and last year. So we're going to do the example. I have all the assumptions written up here. I always put the value drivers or the assumptions up top, and then we're going to calculate these cash flows. Then we'll come back and calculate the NPV, IRR, and payback of this project. So let's get to work. So here is the spreadsheet. And so let's start off with our labor savings. That labor savings is assumed to be $7.4 million a year. I'm going to anchor that. And copy that over. We're going to get additional sales lift by having the right products at the right time of $7.5 million. We'll anchor that. Copy it over. However, that $7.5 million, I need to account for the cost of the items that I'm selling. So I'm going to do minus that $7.5 million times, I have an assumption that 80% of the savings is in actual operational expenditures or COGS. I'll anchor that. So you can see that actually 7.5, it's only going to net you 1.5. To the operational and maintenance expense of the robotics, which includes, say, electricity costs and labor to maintain it, is assumed to be 10% of the CapEx. So I'm going to anchor the 10%, multiplied times the CapEx, anchor that. Depreciation. I've already typed in the 10-year depreciation schedule, which is actually over 11 years. So instead of just taking 30 million divided by 10, I'm going to take 30 million, anchor it, times the depreciation schedule for that year, do not anchor it, and then copy that out to the 11th year. So now I can calculate EBIT. So I'll take my, actually I can just be able to sum up all these numbers above. Whoops, I made a mistake there. That depreciation, I want to show that as a negative number. So let's change that to a negative and copy across. So here's a choice you're always going to have when you're doing modeling. Do I show subtractions as negative numbers in the value of the input, or do I do it and when I do the subtotal and do a subtraction there? It's done both ways all the time. So in this case, we are showing it. I'll always give you a clue when I do my spreadsheets, because I'll actually put negative sales lift, a negative negative depreciation, negative OpEx here, and just giving you the clue that these already been subtracted, so I can just sum up here. I can then calculate taxes. Just take my net operating profit, or EBIT, times the tax rate. Tax rate is 33%. Anchor that tax rate. Notice that first year's taxes are negative. That means that those losses can be used to offset taxes in other parts of the corporation. And then I have NOPAT. It's another name for EBIT after tax. It's net operating profit after tax. I can just take my net operating profit before tax, my EBIT, and add the taxes. Now notice here I didn't have negative taxes here, so I need to actually subtract tax here. All right, so it's EBIT minus the taxes. If I put negative taxes there, I would put a negative sign in front of this, and then I can just add across. So again, you just got to keep track of how you input the values. And there are my EBIT after taxes, or net operating profit after taxes. I'm going to lose $4 million in the first year and make $3.9 million in the 15th year. And now I want to go from profits to cash flows. The first thing I'll start with is my EBIT after tax. That's already been calculated, so I'll just copy that right across. I'm going to add back my depreciation. So I actually do have to do a negative sign here to flip this sign over here. So I'm going to add back my depreciation. I'm going to subtract the CapEx. Well, it's going to cost me $30 million today. And then I'm going to get $0.25 million in year 15, but I need to pay taxes on it. So it's going to be the $0.25 million times the tax rate. We'll just assume the same tax rate, 33%. Whoops, let's start that over. It's going to be that residual value, 0.25, minus that tax rate, times the difference between the scrap value, that residual, and I'm just going to say minus 0. Since this item's been fully depreciated, it has a net book value of 0. So I didn't even have to do the schedule. And then I can do my change in inventory. Well, the assumption is I'm going to save $1 million in inventory because of better utilization of space. But we'll assume the project only lasts for 15 years, so I'll just take it out in year 15. So this is an example of a finite life project. We'll assume at the end any benefits are going to go away. There's also a benefit of space savings. So we said that there's $4.8 million is the benefit of the space savings. So it's the opportunity cost of the space. But again, we're going to assume this is a finite project. Those robotics don't last forever. So I'll take away the benefit after 15 years. And now I can do my free cash flows. I should be able to just sum up every number above. So right now I need to spend $30 million, and then I start making $4.8 million, and then that last year I'm losing $1.7 million. And then the last thing I can do is calculate my NPV, IRR, and payback. We'll assume a discount rate of 5%, so I can do an NPV equals NPV. Put in my 5% discount rate, comma, put in all the future cash flows. Whoops, looks like I put this in the wrong spot here. Let's just fix this. That's I put under cumulative. So let's just sum this up. It's the same values, it's just in the next row. So again, I can do my equals NPV, put in my 5% up here, comma, my future cash flows, and then add that first cash flow, since the NPV function assumes the first cash flow is year 1. And let's see what that value is. So it's $16 million NPV. So that project must be giving me more than a 5% return. However, notice here this cash flows, negative, positive, turns negative. That means I can't use IRR. So notice I have the IRR function here. And even though it says 13%, I cannot reliably use that number because in theory, there are two IRRs to give me the same value. And then the last one is payback. I'll just do my cumulative cash flows here. I'll start off with spending $30 million, and then I'll take that $30 million and add the first year's cash flow, come across and see when that breaks even. And it looks like it turns positive in the 6th year. So I'll just put in 6 years as the payback. So this is a way in which corporations could evaluate whether to automate a warehouse with robotics, incorporating both labor savings, additional sales, the OpEx of running it, the depreciation, the space savings, and so forth. So this is a good example of a real life example that I worked out with some supply chain folks at Penn State to be as realistic as possible at the time. So in this topic, we've looked at how to show the value of corporate investment, in this case, automating a warehouse space. One quick note, positive NPV investments should increase the value of the firm. As soon as the market learns of the new automation, the value of the stock should increase. In theory, the impact of that investment is the NPV of that project divided by the shares outstanding. So if you created an NPV of $16 million and you would divide that by the number of shares outstanding at Walmart, and in theory, that should be the impact of the project on the stock price. However, the market needs to figure that out, so you might need to do a press release. You need to get that information. Otherwise, they'll just start seeing the cash flow savings over time. Now, I did say there's an option to expand this project to other warehouses. So actually, the value of this project is actually much greater than this NPV, because if you think of this as a trial, that you could maybe expand it to the rest of the warehouse, these savings could be much greater. So when you have real options to, say, expand a project like this, the value is much greater than even the one you calculated based on this small test. So in this topic, we talked about how to value a real-life corporate investment. The next one, we'll do some sensitivity analysis.